Good morning, everybody. Welcome to the Flow Show. Hopefully a bit of a busier day than what we got yesterday with everyone over that side of the pond on holidays. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Yeah, all good, all good. Good morning, everybody. Ready to go again.
Ready to rock and roll. Well, let's rock and roll in China, shall we? They've vowed to continue to implement measures to expand demand to get the economy rolling once more. Bit of a surprise cut or size of the cut to the LPR that was touted. They were expected to cut. They left the 1 year loan prime rate unchanged, 3.45%, but they cut their 5 year by 25 pips instead of the 15 pips expected. So they cut that rate to 3.95%. So a bigger cut, if I can find it, where are we? A bigger cut than was expected. 10 pips actually expected the cut there. They went a full 25. They then sent out their banks to sell dollars for yuan to keep that move from getting too far into the currency, weakening the currency too much. So they've been out mopping that up again overnight. So a rate cut, and they're potentially going to keep easing to get things rolling in China. So still on the easing path, still got inflationary or deflationary problems, still got problems internationally as well as domestically. So still not looking too good over there for the moment. Over in Japan, we've had another round of jawboning and worrisome talk, shall we call it. Suzuki came out with his usual closely watching FX moves with the highest sense of urgency. Then he said they are aware of some views that the new NISA programs, that's their new ISA savings programs that they've increased the sizes of and whatnot, are causing a capital flight and yen weakening. Maybe that's what's been behind their recent jawboning that they're seeing. Should really cause capital flight, of course, unless investors are using that to invest abroad, of course. Then we had a Ministry of Finance official, Mimura, saying that they are always communicating and coordinating with other countries in case for the need for currency intervention. They are mindful of maintaining safety and securing liquidity in FX reserve management. They say they can sell assets such as savings and foreign bonds in FX reserves when it's necessary to intervene in currency markets. Again, pretty strong, pretty heavy comments from all these guys. That's the second time now. They're really up in their game in terms of their threats here, which is a change of the norm. We know they tend to do it gradually, build up as the yen levels move, but they again seem to be going blood and thunder here. Kay, do they know something we don't?
I don't know. I found it very detailed what Mimura said. We know that they are always in contact with other central banks, right? That much has been made clear over time. I don't know. It's I mean, in reading between two thoughts. Are we going to wake up one morning and hearing that they at least checked rates somewhere? It's very possible. On the other hand, it feels to me as well, and there is as much to say for that than possible intervention surprises or so, that they are scared about what's to happen between now and when the Bank of Japan really is going to move. So we still have 3 weeks or so to wait until we will know much more, hopefully, about the wages. And that could potentially create 3 weeks of uncertainty, 3 weeks of JGBs being stuck where the rest of the market moves up and down, but sticks at higher levels in the yields. That's really I guess they just see what's happening not only on the dollar yen but also on those yen crosses, and they probably are looking at that yen yen index or so, trade weighted index, and seeing that it just continues to plummet. So yeah, you know what, we can never rule it. We can never rule them out. We can never rule them out. We are at fresh latest highs in euro yen, yen crosses Aussie and Kiwi and stuff like that. It's probably making them very nervous, those moves. And if they want to buy time, they may decide to get some, or would it be stealth or other interventions just to calm down? Because not doing anything with the ease with which the yen is weakening right now, yeah, they know as much as the market. They see where things are going with the yen. So we could be trading, just to name the dollar yen, we could be trading 155 before we know what's going on with the wages. And then instead of having the effect, a potentially positive effect on the yen, because that will be the first mover, your move back down is going to be 150, not 145 or 140, right?
Yeah, yeah. I mean, I've got the old tinfoil hat on because I was looking at this. I'm keeping an eye on this in the corner of the screen. Canada came out 14th of February after those potential first demands got submitted. Now the next lot have come out today after we've had these two potentially the workers submitting their demands. My conspiracy hat thinks that maybe they've had a sniff of what's been submitted, and they're seeing potential problems, i.e. wages potentially not going up as much as expected. Yeah, this is wild stuff I'm thinking about here, so don't hang your hat on it. But I'm very suspicious why they're coming out so strong at the moment. It's either they're covering their asses in case inflation comes back further, wages aren't as high as expected, the economy suffers a bit more, making it not feasible for the BOJ to end easing. So yeah, they're either covering their asses or they know something we don't. But yeah, I'm very suspicious. You know what it's like, Kay. You've seen this often enough. They don't tend to go from weak jaw boning to strong jaw boning so quickly, or come out with it. And when people change what they do, it gets your alarm bells ringing, especially in markets. But it could be nothing, of course. I could just be fantasizing over nothing. But yeah,
they can hold this level of warnings for a while before even doing something. And yeah, who knows? Conspiracy theories are never too far away when we talk about Japan. They can be massaging things and knowing what's coming. And but if the news is not good about the wages, I guess they are going to have to go to work seriously, because that would mean that I think regardless what happens in anything, I think the UEDA, it's now or never. They have to go back at least to zero, because there's a lot of pressure on the regional banks as well over there, with rates being negative. But yeah, if they don't get support from the wages, I fear the worst for the yen.
Have they put themselves in a situation where they've got to go whatever now? They've got to start tightening whatever, even if the data doesn't, hugely conform to what they want.
Otherwise the window will be closed.
Yeah,
I mean, it's not. And if you only hide behind inflation, that's not going to support the currency for very long. If you don't have the economy behind to support. That's the problem. I mean, only inflation, because the whole market hangs on those inflation expectations and inflation being sticky, so the central banks can't cut. But the Fed is okay not to cut because they've got growth behind them. They've got months, even years of like a very good labor market, very tight labor market. They got years of higher wages. They got or months and months at least of higher wages. They got the economy that grew surprisingly strongly in 2023. We could argue that the ECB does not have all those trump cards in hand. They do have sticky wages, they do have a sticky inflation, but they don't have that growth. And then even if we are at 108 and FX is really stuck for now, we still saw globally the euro weaken a bit versus the dollar. For instance, the dollar being relatively strong versus currencies, globally speaking. Sorry, but in Japan you don't have that. So, and if you then have to stick with negative or rates, like you can't even take them above zero if you don't get the support of the wages, if you don't get the support of the economy, because we saw the economy was dipping again as well. I mean, what's going to happen, you know? I mean, this is not a very good cocktail. And then even if that inflation remains then sticky, if you don't support it by growth, I don't think people will continue to buy the currency just longer than the effect of a rate hike.
Yeah, no, I agree with that. I agree with that. Right, let's move on from that one over to New Zealand. It's a day of bank changing forecasts. ASB Bank now expects the RBNZ will cut their rate in November, not August, so that's been pushed back. Some of the banks like ANZ are already looking at potential hikes to come from the RBNZ. The RBA minutes, bit of a rinse and repeat of all the last 4 months of RBA minutes, and the board considered the case to hike by 25 pips or to hold steady, and they decided on balance it was best to hold steady. One thing I will say about this has been pretty much the same line from the RBNZ, as I say, for a few months now, that the board considered the case to hike or hold steady. The change will come is if they consider to cut or hold steady. That'll be the turn. So this is a deliberate language line that they're putting in here to make it clear when they switch to hold or cut. That'll be their change on that one. Riksbank's Floden says it's not necessary to wait for the ECB to cut. So on the subject of whether they will all wait for one another or who's going to go first, over at the Riksbank, they don't care, supposedly. Bundesbank, in their monthly report, said Germany, this is a proper no shit Sherlock headline, Germany is likely in recession now on weak external demand, muted consumption and cautious investments. It'll be a surprise if they're not in a recession. They said the German recession doesn't mean it will be a severe downturn. BOE's Bailey is currently waffling on about the monetary policy report in the Treasury Select Committee hearing. He says we are looking beyond the temporary period when we expect CPI to return to target this year. We think the economy is already showing distinct signs of an upturn. He says it's good news that the economy is at full employment. Says he's looking for more sustained progress on the reduction of more persistent elements of inflation. That'll be like wages, services inflation. Says we are seeing some signs pay growth is adjusting down in line with lower headline inflation. Says we don't need inflation to be back at target before cutting rates. Again, borrowing a line from the Fed and others. FT been out a report saying that the UK corporate bond market is experiencing a resurgence due to increased demand from pension funds. This follows after regulations. Remember the blow up in 2022 when pension funds got caught with their knickers down, over leveraged as rates went higher. So new regulations to limit excessive leverage by pension funds after that have apparently spurred demand for corporate bonds. Phil Smith of BlackRock said that demand should remain robust, with sterling-denominated corporate bonds tending to make up the majority of these funds' credit exposure. He says that now many funds are preferring to buy corporate debt because they offer protection from interest rate moves without taking on leverage, as well as higher yields than government bonds. It's not just UK pension funds apparently that are interested in this. A lot of foreign funds are looking at this as well, but the main concentration has been UK funds. So that's currency neutral in the main for that. But as I say, there has been interest from other firms as well, and I believe some Eurozone companies are also starting to issue some debt in sterling as well, tempting these pension funds. So much for good old Brexit locking things up. There was a little bit of data, even though Canada was on holiday. There's no rest for the wicked at StatsCan. They need all the help they can get, though. Some PPI data from those guys. Pretty soft on the numbers there. Year-on-year PPI down 2.9%. Was soft on the month as well. Raw materials year-on-year, another negative number there. Though there was a bit of a uplift on the monthly numbers, but otherwise negative numbers there, which will feed into CPI, which we are getting today. So that will keep us ticking over. Rate cut changes. Barclays says hopes of an imminent rate cuts have faded further in the US after the higher than expected inflation data. They expect the ECB and BOE, as well as several other EM central banks, to start easing before the Fed. Goldies, they've had their Tipex out. Well, the paint wasn't even dry on their prior call. They now see the BOE cutting rates in June versus their prior forecast of May, which they moved to May from June 2 months ago. So they don't know what they're doing. Bloomberg has been out with headlines saying there's a 6 trillion wall of cash sitting there because the Fed are delaying their rate cuts. They say investors are ploughing billions into money market funds by the day, and corporate treasurers are hoarding record amounts of cash. They say this is because the more time it takes the central bank to begin cutting its rate, the longer that cash held in money market funds should be able to earn 4, 5 or more %, which will stop investors from looking further afield for higher risk, better yields. So this is Bloomberg, so take it with a pinch of salt. 6 trillion wall of cash sitting in money markets or sitting in yields more than looking for risk. That's something that they say could change once the Fed begin cutting. Geopolitics, the US, following the EU, is considering slapping some sanctions on Chinese companies, it says, or believes are helping Russia with its war in Ukraine. We heard a week or so ago the EU were considering that the first time they were going to look at Chinese firms, sanctions on Chinese firms, apparently helping Russia in the war. So again, that further highlights that international relations with China are not yet on the up. Kate, anything of note you've got to bring to us?
No, I think you covered most of what's going on. Let me quickly run through the what we've put on our things. No, I think we've talked about the best what's happening. Well, the only thing is that just after the Chinese rate cuts, there was persistent talk of Chinese submarines being in the market, trying to sell a few $1 China again. What they usually do when PBOC does something, but it just tells us they want to continue to keep a very tight leash on FX right now until they really will see improvement in their economy, I guess. So it's a bit useless to try and fight it. I can't really be bullish Chinese yuan yet, but the fact the longer they keep it in check, the probably if there is anyone really wanting to challenge them, the longer those people will have to wait and perhaps give up in the end. But yeah, just interesting to know is that despite their rate cuts and stuff, they still like stealthily intervene in the markets in FX. For the rest,
Yeah.
I think we covered everything there.
Yeah, as you can see there, there's a reaction rate cut, and the bank's coming in obviously in CNY, but the effects is seen more so in CNH. So yeah, that one's still pretty much contained, as you say, not going anywhere in particular. I'm happy with that, staying short. But if we do get above this zone here, then the picture might be changing. But for now, yep, they're keeping it in lockstep. Ali asked a question: why is the market sentiment showing bullish for the FOMC minutes? I don't think there's much pricing going on for the FOMC minutes, Ali, and nothing that's happening this morning is down to what's expected from the minutes. The minutes very rarely nowadays have any market moving headlines in them. They can do the odd time, but not as much as they used to, because we hear from all the Fed heads 30 times over since the last FOMC. So if the market doesn't know what they're up to by now, then it deserves everything it gets if it's waiting for the minutes to pop up. But yeah, there are occasions when something can be in there that we haven't heard, but I don't think the market's trading anything to do with that right now at the moment. We are seeing a bit of a break up in euro dollar coming in now, finally trying to take on this 108 level. It's not going to be an easy job. We got that prior high just ticking above the 108s. We're just inching above that. So we are trying to call it a little bit of a breakout. It needs to obviously start holding these lower levels. So 107.90 on a dip. If it holds there, then we should be pushing on. Then we've got the old traffic zone, 108.30.70, but it's creeping. As I said, it's stopped going down, and that's the first thing you want to see if you want something to go up. So maybe we've got a little break to the upside, though volatility is still pretty low, so I'm not expecting rockets from this one. But we shall see. I'm still a bit long off the 107s and my core longs, so this is good news for me for now. And failing that, we'll probably be back at 107.70 for a change, as we have been for a lot of the time. Cables not following as quickly behind, and you can notice that difference by looking at euro sterling, but I'll move on to that in a moment. Trying to claw its way back above 126. Just feels at the moment it doesn't really know what it wants to do around here. We've never really got a proper test of that 125 area. That was my next level down below, down around that fib again, and 125, as you can see there, going back to December, a solid level. So a little bit of a waffling going on in the middle here, so not really much interest for me personally. Euro sterling said we're having a little test of this 85.70 level. That might be putting the brakes on what's going on in euro dollar, not clawing up. Also into cable, why it's not rallying as much. So if we break this level here, 85.70, we should go for a wander up towards 86. That should keep cable under pressure and likely help the euro continue to roll higher as well. It's a bit of a mixed picture. There's a lot of, it feels like there's a lot of yen behind some of these moves at the moment. Not dollar yen, that's sort of staying caught in the currents. But if you look at the yen crosses, they're all sort of starting to poke up a bit. This one I'm keeping an eye on, Aussie yen. I'm going to be looking at a little short on this one. The reason being we're up, let's go on the daily, we're up against some very strong resistance. This trend is very strong though, as you can see. It keeps going up. It's had a bit of decent refresh, couldn't even get down to the fib. So it shows you how strong this trend is. And even, you know, for the last early part of 2023 into 2024, it's keeping a decent bullish trend. But we are up against resistance, so I might have a little look at that one, a little short try on that one. I'm not going to give it a lot of room though, because if it breaks, there's likely to be some decent stops above, clear out 99, and we're probably off to the races on this one. But this one's up against resistance, whereas some of the others like euro yen are, you know, still ploughing on and getting up towards recent highs. And I think this is having a bit of a drag effect on some of the other currencies as well. Aussie dollar, that's having a little a mini breakout, shall we say, finally getting above 65.40. We've been knocking around. Next level's not too far away. Then we get into the traffic area up towards the higher 65s. Still a long way to go for this one. I'll just come out a bit further because we got this big 66 area up here. So that's really the big level it needs to get back above. But it's having a go. You got anything? You seen anything in Aussie dollar that's taking this one much higher, or just
looking exactly at the same pictures? And but as I was saying earlier over prior shows, it does look like the Aussie was one of those currencies, together with the Kiwi, the Antipodians, doing a bit better perhaps than the rest, showing signs at least that they were more willing to go higher than the rest perhaps. Do you know what? I think there's a bit of cross trading around there as well. You know, we're seeing like the euro ticking up, and then some euro crosses ticking up, like euro yen or euro Swiss or so. But then against that, you got the Antipodians who are actually doing pretty well, even against other currencies that are going up. Yeah. So, well, the RBA in the minutes weren't really in a hurry to start cutting, and the RBNZ or was a bit was pushing back against it as well end of last week, and then you've got those expectations from the banks. Now that is all creating a kind of a positive environment for the Antipodians as well. Got to think as well that those markets are smaller in volume than stuff like euro, dollar, dollar yen, or even cable or so. So those have could actually go a little bit faster than the rest, and I guess that's what's happening right now. Yeah, and because the Kiwi is also going for a little bit of a break, but then as you're showing there, the Euro Kiwi is trading relatively at relatively low levels compared to where we were a month ago, for instance. So yeah, it's all a different little kettle of fish, and I think the market is trading a lot of crosses because you've got the vols coming down in the majors, and then that usually is pretty decent for stuff like carry trades. And then we know the Japanese, for instance, they love their Aussie yen. They may like the Kiwi yen as well, and it's probably also underpinning the Antipodians right now because it's just like closer to home for them as well.
Yeah, good point by Nashi. We have Tinto dividend announcement tomorrow, so that will be one for commodities to keep an eye on if you're trading commodities. And Gav, yeah, 66.20, 66.40 in Aussie dollar. Yeah, some of the old levels that we knocked around on the way down, and now we've got to knock around them on the way up as well. So yeah, there's a lot of levels there as well. That 66.40 was a bit of a one, that zone up there. So yeah, lots to look at. For me, I'm apart from that Aussie yen, I'm not looking at much new right now. Just managing what I've got. S&Ps. Again, it's not looking as bullish as it was the last couple of weeks. Let me find it. There we go. Let's come in a bit. So yeah, we had a little creep up. We haven't held the 5K, and now we're finding resistance there now. So that is again a little bearish signal for you there. That perhaps we're done with the top side for now. So just keep an eye on that one. I'm going to have to watch to see what levels we start knocking out. We've got another little one here, 49.80s, 85. So that's support there. If we break through there, then maybe we're going to start mooching down 49.50s, somewhere like that. But definitely it's looking more tougher to get see some upside. Well, until the dip buyers come in and take it through the highs, as they often have. But for now, yeah, a bit more balanced going on here in stocks. So keep that in mind if you're trading that both sides of the fence for that one.
And maybe their rebounds are now finally done, and those who were very late and very under invested have what they have what they wanted, and that's
Yeah.
stabilizing effect. And then tomorrow, Nvidia. I think tomorrow, Nvidia. It looks like the whole equity market worldwide is watching what Nvidia is going to come up with tomorrow, and I guess that's going to be right or wrong. That's going to be a big mover in any market, it seems. So I guess on we have to revisit all those equity pictures on Thursday, mate.
Yeah, I think so. I agree with that, and I think it's going to be potentially another piece of the puzzle for this one as well. You know, if those earnings are strong, well, obviously depending on where we are when they drop, but if those earnings are strong and we're sort of down these levels, then it will be interesting to see if can we break these highs. If we can't break that high on strong Nvidia numbers, then that's going to be pretty much a nail in the coffin for me that we've seen a top here, temporary or otherwise. If we don't break that high. So I'm going to be keeping an eye on that one. If that happens, I'll probably chop out a lot more of my long and start getting my stop behind ramped right up to protect the rest. But there'll be a big signal if we rally but can't break those highs. On the yield front, quick look at US yields, as we often do. Still mooching around. 420 is the important level down here. We've got intermediate highs around these 430s, but the next real level isn't until sort of getting up to 440s and a big one at 450. So while we hold this, I'm not expecting the dollar to weaken too far at the moment. As I said, that's probably why dollar yen's not dropping too much, caught in the currents between what's going on in the other yen crosses. But yeah, as long as we're holding 420, then the dollar should remain fairly well supported in the main. So that's your marker for that one. Kay, you got any inspiration today? You could look anything on the loonie? We got that CPI data coming up.
Yeah, we have that CPI, right? Okay, that's and being well, apart from speakers also, and also we can't forget that the U.S. Treasury auctions start again this week. That's going to should be at least the bigger mover of the day, because in data wise, it's really the only thing that's going to catch the attention. Dollar CAD is really trading in the middle of the range. We are probably going to try to figure out what's going on there. There's a bit of trend line support, perhaps. You want me to grab it quickly?
Yeah, go ahead, mate. I'll hand it over to you. You got your trend lines on it. Where am I? There we go.
Okay.
Just while you're doing that, Ali, if you've got a TP right on a technical level, like a moving average, then you need to maybe think about adjusting your TP level to either just below it, something like that, because it can be a bit funky. You know, you stick it on a level, the level doesn't get hit, and then you've come 2 pips or 3 pips within getting your profit, and the techs hold. So just think about that. Use a slice and dice if you like. If you're not sure, take a bit off before and then see what happens there. But yeah, always rely on the techs. Over to you, mate.
All right. Yeah, dollar CAD first of all. So we had this little excursion above the cloud the other day. I know quite a few people are watching more and more the clouds now, but we are still below, and that level is still hanging. Oh no, now it's coming down, but it is now just above 135.15. So watch that, perhaps for a close on the dollar CAD today. If you on the downside, it's much lower. We've got the well, it's actually right on the 134, where we had a pretty decent level before, right? And that's probably going to be your extremes, I would say, for the day, to see where dollar CAD closes, whether it's above or below those bigger levels. On the intraday, 134.65-ish down to 134.5. That's the level to watch. And then here back, if we get the confirmation back above 135.40, then I would say that's prone for moving higher. Right now, the way the dollar trades, it's still very much in a range. Okay, so we're going to need breaks and hold those breaks. All right, to really go on a move. One that I was keeping an eye on, this Euro cat, and I thought at one stage it was really ready to go for a walk lower, but it held rock solid. So this is one, perhaps if we get a bit of a surprise reading on the CPI, let's say a weak one in this case, keep an eye here, 145.90, 146, 146.05. If that starts to break, then I think we can go and have a look at the high 146s. And I will say with where the FX volatility is now, the option volatility is now, those vols have been coming down, down, down. And as you know, I repeatedly say it's usually strengthening the ranges. So we are going to need real breaks on the dollar cat. But for example, your process can move much more freely within those bands or ranges, okay? And the fact that we are starting to turn here means that we may go for at least a retest of 145.90 figure, and if that breaks, high 146s, okay? High 146s, I think, is going to be decision time or reassessment time if it would go up there, all right? Because we are still firmly in this broader range. And one that is obviously on my radar is the cat Swiss, because I have, and I know a few people are in this as well. Look what's here, okay? This trend line here, that comes in around about where we are. So for us, people who are short Swiss is one side, but you've got, of course, the Canada side on the other side of the pair. We would love to see a bit of a sticky CAD number, perhaps, getting it through. But then we also are going to need a confirmed break above 65, 65, and 65. Well, call it 65, 70. All right, 65, 65, 70. If we get above there, then I guess we may push quite a bit higher. If not, then I guess we are going to stick around in a range here, somewhere between 64.80, 65 the figure, and 65 and a half. That is one that I'm, of course, always keeping an eye on, the same as Euro Swiss, which is showing signs of trying to get through the next little level here, to try and get up to the higher 95s. The euro helped it on the euro dollar, helped it on the way a little bit, but also just euro crosses, like euro versus the low yielders are holding up pretty well too. So if we get up there, then I really think we need to pay close attention. And again, I'm going just to repeat what I've been saying. Yes, the S&P is dovish now. Yes, we have seen those data starting to come off as well. But there's this little line Jordan said in his intervention somewhere in November, December, saying like, please don't go and destroy all the good work that we did against inflation. But we have seen inflation coming down. So I still think we are in a broad recovery of all things against Swiss franc. But here as well, dollar Swiss, we don't have any US data. So this, I don't think we are going to go for breaks either side today of support or resistance. But if we would ever, for any reason, start to tackle 88 3/4 figure, then this should again become a bit more explosive, I would say. I don't have much more to show right now. You showed the cable, you showed the euro dollar. Euro dollar is on smalls, resistance around here. I've got a bit more around 108.20, and then the zone Ryan showed. Yeah, the dollar is is kind of interestingly, even without moving too much on the yield, is kind of interestingly against quite a few currencies, giving back its gains relatively easy. And that's, I think, again, the market trying to look for what's going to happen next already. But in the meantime, okay, that's where we are. I really don't. Oh, gold. Okay, yeah, Dirigi, I know you're a big fan of gold, right? Where are we? To me, we are in the range, but we have to note that since China came back online, right? That was your close on Friday, and then we had a Sunday evening, bit of a move lower, and then they bought it again. I have got the impression, because you look at the timings where it happens, that they are still part of this moving gold. But 2030. 2035, and then we are looking at higher levels around 2045 to monitor. We're still in this range, and I mean, I don't really want to get involved too much for more than short-term stuff, really. 2015, I would say, is your first level here. We've seen several levels. And then we're back into this 2010 and 2000, right? Those are your levels. And I don't have really preference on either side right now. It does look like it's relatively easy to creep back up for now. But really, I don't have any more preferences. And with that, Ryan, I think we can call it an early one today.
Yep, thank you very much, mate. Yeah, I'll just flick it quickly onto the data again, just to show you what's upcoming. Not huge amount of change expected from the CPI numbers. Headline CPI year on year expected to fall a pip, unchanged or a pip less in some of the other core measures that they like to use in this one. So really for the loonie, let's see if it follows US CPI. Let's the close relation, maybe we see a bit of heat coming into Canadian CPI as well, or if it goes the other way, that's going to be a bit more of a divergence between the Fed and the BOC potentially. So that's what will get the loonie moving. So there's the numbers there. I'm sure your own calendars to look at. Yep, we shall leave it there for today. Hopefully we get a better session to trade than yesterday. It's looking okay at the moment. Have a great day, everybody. Thank you for coming and supporting us at the Flow Show. Thanks, Kay, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.